Hi, I'm Eddie Sunderji, and welcome to Your Finance TV. It's a Friday, so we have the one and only Jay Pelosky from TPW Advisory with us. Jay, how are you, sir? Welcome back.
Marty, great to see you. It's my lucky day. How are you
Absolutely. Well,
doing?
it's my lucky day. I'm sitting there fighting with Bloomberg. I'm seeing you on Bloomberg. I look up, you're everywhere. And now I have the pleasure of you giving your thoughts and commentary to us today. So thank you for gracing us with your presence, sir.
Well, Bloomberg TV is kind of like off Broadway, right? You want to go and warm up before you hit the big stage, and the big stage is obviously Your Finance TV because we get a chance to actually dig in a little bit, right? I mean, Bloomberg's great, and I love going on the show with John Farrow and the folks there, but it's much more boom, boom, boom. Whereas here, I think the benefit for your viewership is that we can expound on things and go deeper than really the time frame of Bloomberg, or not even mentioning CNBC, right? Which is 5 second sound bites. So I love coming on with you and Scott and having a chance to dig into our thinking and why we're saying what we're saying.
Well, Jay, and we love having you. And you know what? Let's get right into it, right? We want to get into the thick of things and dig right in, as you say. So, you've obviously published your monthly musing, your weekly musings, and and this week's title is On Track. So, talk us through what's on track.
Yeah, exactly. And you were right. It is the monthly. So, as a reminder to the audience, we write every Friday, and 3 Fridays of the month, it's the Friday musings. And then that last Friday of the month, this month, I mean, I guess today's, the 1st of December, but effectively the end of November, we write our monthly, right? And the monthly is our deep dive. This one's coming out at about 5,800 words, 29 different charts and tables from 16 different research sources around the world. And it really is, a compendium for us. And it allows us to really make sure that we have everything kind of in place, in sync, well structured. And then next week, we'll go in and update our model portfolios. So that's the process. And we're big believers at TPW Advisory that if you're going to do global macro, you need to have a process. Otherwise, you're going to get swung all around by the latest issue here, there, and everywhere. So, on track. And what does on track mean? It means simply that the view that we've had for some time, which is very constructive into year end, bullish on risk into year end, and then constructive on 2024, as we laid out a month ago with our 2024 outlook, we're on track, right? So we had a great November. And didn't November just remind us as to why market timing is so difficult, right? You had a lousy August, lousy September, lousy October, and then boom, a rock and roll November that completely erased all the declines of the prior 3 months. One of the reasons why we at TPW Advisory aren't big on market timing. It's just too hard to do it and do it well. To sell at the top, buy at the bottom sounds great, but I've been in the business for 30 plus years, and I know very few people who have done that once, let alone more than once. So we're on track near term. And look, we've had a huge move. So a pullback here would be perfectly appropriate, healthy. What would we do with the pullback is the question. And our view is that we would be buyers. And we're buyers because you still have solid seasonals, right? December, best month of the year. You still have improving technicals. Every major index, every major region on the equity side, ACWI, ACWIX, EFA, EM, all back above their 200-day moving average. So those are reasons to say supportive in the near term. And then looking out 6 to 12 months, another reason why we'd want to buy pullbacks if we get anything here in the next couple of weeks is that our 2024 outlook remains intact, and in fact has kind of already been rolling out and performing. Because remember, our number one macro surprise for 2024 was lower than expected inflation sooner than expected. And what have we had? exactly that, right? In the US and in Europe. Europe inflation for November was 2.4% year over year. It peaked a year ago at 11%. So Europe is already at the 2%. What was the core PCE inflation print yesterday or the day before in the US? 2.4% annualized over the last 3 months. We are very close to that inflation target, and that sets up the rest of our surprises, including a return to macro stability, which is a big thesis of ours, because what it does is it's going to unlock the big inflows that went into money market funds this year. They're going to start to come out. And that money flow, I believe globally now, money market funds have $8 trillion. In the US, it's close to $6 trillion. And so when we get that macro stability that we see coming forward, as inflation comes down, Fed goes from rate hikes to rate cuts, dollar softness, global economic recovery, et cetera, that money is going to start to flow out into risk assets. And then the question is, and I'll wrap up here, then the question is, where does that money go? And we feel strongly that we want to be in emerging market assets for 2024. So this is a change for us. A year ago, in 2022, we were bullish European assets and European banks in particular. 2023, we talked a lot about Japan a year ago, and Japan was one of the best performing markets globally this year, up about 30%. And today, as we think about 2024, we want to be overweight emerging markets, both debt and equity, and we are. And just as a reminder for your audience, I started my career in emerging markets and actually started and formed Morgan Stanley's global emerging market research effort, so far back, I'm not going to name the year, but suffice it to say, I know emerging markets. We know emerging markets here at TPW Advisory, and we are overweight and have positions in every region. So we have positions in Asia, positions in Europe, positions in the Americas. We're long equity and debt, local currency emerging market debt, Asian high yield. We're very bullish on emerging markets for 2024.
That's fantastic. What a way to kick off 2024, punching into the EM markets. So, Jay, this is also your monthly piece. You break down a bunch of different topics as usual. And obviously right now we have COP28 going on. So why don't we kick off with your climate section?
Yep. As a reminder, for the last year and a half or so, we start off with climate because we see that as being one of the single biggest global macro themes out there. Every country is involved in trying to deal with climate. It affects every one of us. And so again, global macro, we want to start off and constantly keep in mind what those big themes are. Now, the challenge has been that we have this dichotomy between rising adoption, right? Increasing amounts of renewable energy coming onto the grid globally, at the same time as the public market equities of renewable energy companies have been a disaster, right? This year, last year, and this year. We have a great chart in the monthly where we highlight the gap between fossil fuel energy company stock price performance and renewable stock price performance. And it's like that. I mean, I'm not sure where the TV is, but fossil fuel up, renewable down. We'll make it very simple. And that's really been a challenge because on the one hand, you have that solid news of adoption. On the other hand, stocks have acted horribly. And that's really for a couple of reasons. One, many of the contracts that were set up a couple of years ago for wind and solar did not have inflation protection because it was pre-COVID and obviously therefore suffered. Two, rising input costs, as we've seen, big factor. And three, you had some real overcrowding issues, particularly in China on the battery and on the solar side. And that has really decimated the profitability of a number of these companies. So the good news is that's all kind of known now. It's also in the price, which is also good. And so our view is that, keeping this on the radar screen and tiptoeing back in to certain segments of the clean energy space makes a lot of sense, because they should be big winners from return to stability, big winners from lower interest rates, and big winners from weaker dollar, because many of them are outside the U.S. But as you say, COP28 underway right now. Not expecting a whole lot out of COP28, particularly for developed markets. The real focus is on providing funds for low-income countries to mitigate climate damage and climate issues. And so very valuable and important work, but not really something that we expect to move the needle of public market securities.
Well, we're still watching COP28 with bated breath. But, you kicked off with your opening statement with some of the commentary around inflation and such. Why don't you run us through your thoughts on the economic perspective for 2024?
Yeah, I mean, I think it's pretty straightforward. Declining inflation, right? Number one surprise for 2024. Lower than expected inflation, sooner than expected. And it's happening in real time, as we just touched on at the open. That provides real income growth, which provides support to fully employed populations on both sides of the Atlantic, which then supports consumption, right? As we saw with the Thanksgiving sales, right? I mean, did anyone not go shopping? Record Thanksgiving sales. So the other thought that we're talking about and thinking about here at TPW Advisory is, while the recession call seems to be an evergreen one, right? People keep talking about recession, though it hasn't happened. I don't really understand why they're not told to, like, hey, come back when you have a different view. How you can keep espousing the same view that's just been flat out wrong for 18 months and still have credibility. I really don't get it. But what people haven't yet embraced is the move or the end of the debate between, are we late cycle going into recession, or are we early cycle going into a global economic recovery? And that was our fourth macro surprise, is that we think that debate is going to be put to rest in 2024, because it's going to be clear that we're going into a global economic growth recovery, where Europe bottoms, already seeing signs of that happen. China, policy traction, policy efforts gain traction, 5% growth. I mean, I love China. People bash China like there's no one's business. Keep hearing about a bad economy, a tough economy in China, yet it's growing at 5%. 5%. We're super excited if we grow 2% in the US. China's growing 5%, and yet every time you pick up a story about China, it's super negative. We're focused on that policy traction in China, and we're really focused, sticking with Asia, on Japan's inflation story, because, of course, remember, inflation is good for Japan. They're moving out of 40 years of deflation, and so we want to see continued wage gains there. We're going to watch in the next few months the spring wage rounds. Very important to see whether you get real income gains in Japan to sustain consumption there. So there's things to focus on, but in essence, a pretty benign economic outlook, which we think sets the stage again for that return to macro stability, that unlock of the money market funds, and that money flowing into risk assets like emerging markets.
Jay, when you break it down like that, the whole economic perspective and the picture and landscape seem pretty constructive and positive. So, it's always nice to hear that versus a lot of talking heads on TV, as you say, who are potentially continuously banging on about recession. So it's always nice hearing that side of things and seeing it play out. Jay, so, obviously, we're not watching COP28, we're watching some sort of political debate or something going on. So why don't you talk us through your thoughts on politics here?
Yeah, politics lines up next in our structure, our global risk nexus, as we call it. And what can you say about the U.S., right? Politics in the U.S. are damaged goods. It's depressing, hard to really understand the gap between supposed popularity of the president and all the success that has been visible through full employment, through low inflation, through better growth in any major economy, through COVID. Just doesn't really make a whole lot of sense to me. But thankfully, we're still, a little far away where we don't have to pay too much attention to the polls. So switching to Europe, Europe has moved from worrying a couple of years ago about the populists. Remember when the Italian populists, Matteo Salvini and others, were going to take over Italy and have it leave the European Union? That was 4 or 5 years ago. Now today's worry is the far right, given that the far right party in the Netherlands, the Freedom Party of Geert Wilders, came in first in its recent election cycle. Our view is it's not really going to change much of anything. Much of the populists found it very difficult to govern. Far right is going to find it very difficult to govern in a coalition. Not really something that we have to worry about in our view. And it's interesting to remind ourselves that while geopolitics and conflict, like as we see in the Middle East, they get all the headlines, they really don't move markets. And the fact that ACWI is, fully recovered and breaking out again, even while the battle rages in Israel and on the West Bank, is a signal that, again, you have to be able to separate headlines from actual market risk. And I say that because the other area of focus politically is in Asia, with Taiwan's elections coming up next month in January, and a lot of talk about how if the candidate who is pro-independence could create a dynamic with China. Again, we don't think that's really likely to be the issue. China has more than enough on its plate dealing with its economic challenges, notwithstanding the 5% growth, still have challenges, particularly around housing. That's going to be the focus for China. So there again, we don't really see the point of focusing heavily on Taiwanese political risk, for example, relative to our emerging market enthusiasm.
So, Jay, one of the things that you've been highlighting, I think a lot of people have kind of missed this. We've obviously been through this aggressive rate hike cycle, modern times, and you've been quite heavily focused on the fact that we're now seeing that rate cutting, especially led by the EM side of things. What are your thoughts from a policy perspective on a global basis?
Yeah, I think that's key, Marty, again, because it's people where people have really gotten the last couple of years wrong is in simply using the playbook of the last 20 or 30 years in a period of time that has been completely ahistorical, right? With a once-in-a-century pandemic and all that flows from shutting countries down, basically locking people in their homes or in their towns, and all that happened as a result of COVID. The idea that you'd use the same playbook in a period of time that's so ahistorical is just never made sense to us. And I think one of the benefits, YourFinanceTV is a little bit of an insurgent in the media space. One of the benefits of people paying attention to independent research boutiques and advisory boutiques like TPW Advisory is that you don't get the same cookie cutter thinking that comes out of the big research shops, which is like making sausage, right? I mean, I was a big part of Morgan Stanley strategy for a number of years back in the day. I know how the sausage is made in these big companies where you have 20 different people, all with a view, and you got to shoehorn it into one firm view. Guess what the firm view is? It's nothing. It's basically like what satisfies the most people. Independent thinkers, on the other hand, can say, hey, don't use the same model as you did over the last 20 years because we're in an ahistorical time. We need to use a fresh model. We need to be focused on facts, not on surveys. Big issue this over the last year, right? Surveys, negative. Facts, full employment, continued consumer consumption, etc. Facts say, you can have a different point of view. And so policy-wise, the big switch in our view is that we're moving from monetary policy-led focus to fiscal policy-led focus. We're moving from one of the most aggressive rate hike cycles in the last 30 or 40 years to a rate cut cycle that is going to be led by EM. People would be amazed to hear a fact that there were more rate cuts globally over the last month than rate hikes. Rate hikes are done. We're now in a cutting cycle, and people need to think and shift their thinking accordingly. And as a result of that, we think that the central banks, we're using the term frenemies. We think central banks are going to be frenemies with investors, because no longer enemies, because they're not raising rates, making money more expensive, squeezing the investor. Kind of frenemies, because rate cuts are what's going to be coming in the next year or so. And those rate cuts and that continued good news on disinflation and that good news on economic recovery, that's good news stacking upon each other. And it's going to provide the support for the upswing. And one of the things that people, again, zooming out a little bit, which I think is really key, is to realize that for the last 2 years, we have gone absolutely nowhere in the S&P. It's again a fact. The closing price on the S&P 500 yesterday, November 30th, 2023, was exactly, and I mean exactly, to the point of the closing price on November 30th, 2021. Amazing coincidence, right? Flat. So what does that mean? That means that over those 2 years, we've absorbed and digested a lot of stuff, the whole COVID thing, inflation, etc. That means that now, coming into the next couple of years, focusing forward, which is what investors have to do, now we are set up for that macro stability and set up for that rest of the world to participate at a time when it hasn't participated for the last number of years. And so the zooming out and understanding that we've gone nowhere for 2 years and we've digested a ton, and now we're ready to accept stability and what that means in terms of risk appetite with all that cash, $8 trillion globally sitting in cash. I mean, wow.
That's a lot of money, Jay.
Even for your money. I mean, I know you swim in a different pond than little old Jay, but even for you, $8 trillion is going to perk the eyebrows up a little bit, right? It
certainly does perk the eyebrows. So, Jay, you obviously touched on some of your statements in your opening statements in regards to your positioning and thoughts on the markets. But outside, obviously, we know that in 2024 you're quite focused on emerging market equity and debt. What are your overall thoughts and picture of where we've come from and where you're looking to go from a market perspective?
Yeah, absolutely. Let's finish up on the markets, because all that other stuff, all those other building blocks are meant to build the foundation for the market view, right? So now it's naturally, again, having a process. Really, if you want to stay in this game for 10, 20, 30 years, you've got to have a process. It's got to be replicable. And we feel like at TPW Advisory, finally, after a few decades of effort, we have a decent replicable process. And so we stack those building blocks. We remain constructive on risk going into year end and into 2024. Any pullbacks we get after a strong November should be bought for that 2024 positioning. We remain fully invested, so we're not trying to market time. We talked about that earlier. No market timing here. And we are overweight equities with a focus on particularly non-US and emerging markets. So while we continue to have positions in European equities, we're heavier overweight in Japan within the non-US DM. In emerging markets, we have for the first time positions, as I mentioned, in Europe, which is Poland. Poland's a big winner from the regionalization of the European supply chain, a big winner from political outcomes where the opposition party, much more friendly to the EU, has won, and therefore the EU is in process of unlocking significant amounts of money to support Poland. People might be interested to note that, one, Poland was the fastest growing economy in the 27 nation European Union in Q3. And two, the Polish ETF was the #1 performing position for us in our global multi-asset model over the last month or so. So positions in Poland, positions in Mexico and Brazil, positions in China. So we also are overweight commodities, right? So one of these surprises for the markets, so our 4 market surprises were non-US outperforms, dollar weakness, industrial commodities outperform. So we've already covered the first 2. Commodities, we think there's a secular shift which is underway slowly and providing a really interesting opportunity. Commodities are big winners when rates come down, big winners when the dollar weakens, big winners when the global economic recovery takes place. All 3 of those things, we would argue, are going to occur in the next couple of quarters, the next couple of years. And so we have positions in uranium miners, copper miners, and gold miners. Gold is breaking out, real rates come down, dollar comes down, gold goes up. So we are pretty heavily overweight commodities. And then to finish up on the fixed income side, as you know, we've been bearish on the Treasury market for several years. Been one of our better calls. Really helped us outperform over the last several years versus our benchmark. We did dip our toe back into Treasuries last month with a position at the short end of the Treasury curve. We really don't see a whole lot of capital appreciation potential with the 10-year at 4.3%. 10-year and up probably now more coupon clipping opportunities than real capital appreciation. Again, because we don't think growth is going to be horrible. We don't think there's going to be a recession. So I don't see a ton of room for rates to rally further at the long end, and therefore find better opportunities than clipping a 4% coupon for a full year holding the 10-year Treasury. And that opportunity in fixed income is in credit. And what's interesting about what's going on in credit is that certain parts of the credit universe are shrinking because there's no issuance, because people are risk averse. And so what we're talking about here, we have 2 in mind. We're exposed to both. One is U.S. high yield. U.S. high yield, the overall market size is actually shrinking because there's been so little issuance and companies, debts are maturing. And so they pay back, they pay dividends. And so if you're a high yield manager, you're getting inundated with money coming in, but really have no new places to put it, which means you have to buy the existing places, which means the index is going to do okay. So U.S. high yield, we have a good position there. And then the other, which is just fascinating, is Asian high yield and Asian credit more widely. And we cottoned on a JP Morgan piece that talked about how they expect in 2024, 12% of their Asian credit index is going to be returned to investors through dividends and maturing payments. 12% of the market coming back. I mean, we like shrinking asset classes. So we have a good sized position in Asian credit, particularly Asian high yield. In that, in U.S. high yield, the bulk in emerging market local currency debt. Remember to add that too. Good sized position in EMLC, which, by the way, has outperformed the ag by 500 basis points year to date. 500 basis points outperformance in emerging market local currency debt. We think there's a lot more of that to come in 2024.
Jay, that's an awful lot to unpack, and thank you for running us through your thoughts on your monthly piece. I would urge everyone to check out your content, especially your big monthly, because you can't grasp enough of it in this half an hour segment. So, Jay, where can people get your content?
Yep. Very simple. Pelosky.com. Look under musings and you'll find everything right there. You can sign up free. It's free. I mean, someday we'll go behind a paywall, but I'm more interested in the markets than I am in making money myself. Don't tell
Jay,
my
why
wife.
would you even say that out loud? You know what? Just a
Exactly.
philanthropic procedure here with you. So this is fantastic. But I everyone get out there and check it out. Pelosky.com. Jay,
Thank you.
thank you so much for your time and your thoughts. And everyone watching, thank you for watching. Good luck investing.